welcome everyone to our meeting today. Before we discuss the agenda, I would like to give a brief introduction to today's main topic. The date is July 20th, year 2000. The Ho Chi Minh City Stock Exchange was founded, and it was the main contributor to the development of the Vietnam stock market. This fact created opportunities for the country to increase their overall capital and to encourage collaboration. This kind of development also affected the accounting methods used in Vietnam. What I mean is that a unified accounting system is needed in order to provide an honest financial situation of enterprises. The Ministry of Finance, or MOF for short, conducted research and came up with the Vietnamese Accounting Standards, or VAS. However, this is hugely based on the standards of the International Accounting Standards Board, or IASB, with only a few tweaks here and there with the help of the European Union. The VAS was officially put into effect by the MOF through the Circular 200 with a view to facilitate the act of writing the enterprise's financial statements and reduce the differences between the two systems. As I said, the VAS is largely based on the IAS, but the VAS has 26 accounting standards, whereas the IFRS has 17, the IAS 41, and the 34 of which are still valid. So you can tell that there are some differences that lie between each accounting standard. The agenda for today is all about the differences between the VAS and the IFRS. They are indeed very similar in general, but they also have some major and sometimes minor differences. I'm looking forward to everyone's presentation and analyses. The first presenter will be that.
The biggest and most noticeable difference should be mentioned before everything else, right? First and foremost, the VAS has the subsidiary letter account, and I assume that everyone has a very thorough understanding of what a letter is, so I'm gonna skip the definitions. Let's touch on the IFRS system beforehand. Users of this accounting system can use the general letter account for years on end without running into any problem, or at least supposedly so. Let's take an example of a company called Alpha, who is a follower of the IFRS system. They can record 10 of entries per day, and in this case, a general ledger account will be still sufficient enough for them to keep track of the information. However, when bust comes to shove and the company has to record about hundreds and maybe even thousands of data per day, the use of a singular general ledger will not hold up. And this is when the subsidiary ledger account would come in handy. The Ministry of Finance has encouraged the use of these in the VAS, as they are basically the expansion of their general counterpart. Let's go back with our example of the company Alpha. It mentioned that the general ledger account would go from top to the bottom, while the subsidiary one would lie in the middle and would act as a controlling account balance. Accountant who access to the subsidiary ledger account can save hours of otherwise sifting through entries upon entries to find a specific data of a supplier or a customer. This is because the subsidiary one would remove excessive details in the general ledger while being just enough for future referencing. Also, there are other respectable benefits such as the error identification process is made easier, or record keeping through the division of labor in portion is more sufficient when combining the two types of letter, etc.
Thank you, Dad, for the thorough explanation of one of the main differences. With that being said, there's also another major factor that differentiates the IFRS and the VAS, and that is the chart of accounts. A chart of account, or COA in short, has a close relationship with general ledger accounts. A COA works as an organizational tool by breaking down lots of daily financial transaction data of a company into a comprehensive listing of accounts during a specific period. In other words, the general ledger is the on-paper meaning of the picture, but accountants base their work on charts of accounts to visualize and present it to internal and external users more scientifically. However, it should be noted that both the IFRS and the VAS utilize the chart of accounts in their financing system. So the question we should be asking here is, how different are the chart of accounts? Well, as for the IFRS, it focuses on regulating the form of accounts under the IAS 1, which means it's rather flexible and unrestricted. The VAS In contrast, organizes its accounting firm in only one way and heavily forces Vietnamese companies to comply, and it can be inferred that the advocates of the IFRS are free to manifest the account firms and system appropriate to their workflows, whereas VAS users, they're forced to deal with the rigidity of the system.
Thank you for the brief explanation regarding the chart of accounts from Han Min. Moving on to the comparison between the financial statements of companies that follow the IFRS and the VAS systems. In general, the most prominent difference between the IFRS and the VAS is instead of 5 usual accounts published, income, retained earnings, financial position, comprehensive income, and cash flow statements, only format statements are posted from enterprises following the VAS. Retained earnings and comprehensive income statements are excluded, while notes to financial statements are included. For all the companies operating in VAS, financial statement following the chart of account and standard financial statement format provided by the MOF in Circular 200/2014 are compulsory, in which assets, liability, equity, other income, and cash flow are required. Moreover, every financial statement in VAS must include a statement of compliance with the Vietnamese accounting standards.
Thank you, Kit, for your very informative presentation on the financial statement. Now my part will go over the fair value principle of the two systems. This principle is one of the 4 key principles in the IFRS. Fair value is the evaluation of an object's price whose reported item is based on the genuine and underlying value of the assets, with the agreement between buyers and sellers. Such a principle has been implemented to improve and validate the fairness of the financial statements. On the other hand, the Vietnamese accounting system uses the historical cost principle, which records its assets at a cost over the time they are held. Due to this characteristic, companies following historical cost principle are incapable of reflecting the current value of their on-hand assets in swiftly changing market conditions. As a result, it is understandable why external users tend to have more faith in the IFRS value.
I am very pleased that everyone has done an excellent job illustrating the key differences between IFRS and the VAS. On the side note, I should mention another minor difference between them is the currency and the language used. As for the IFRS-based company, the currency depends on the sovereign currency of the economic environment in which the enterprise operates, such as dollars, pounds, euros, and etc., while the VAS requires the use of Vietnam's unit of currency, dong. The Vietnamese language is to be used in such statements as well. Should foreign transactions be made, a conversion to Vietnam's unit is needed for statutory reporting purposes. We can safely say that the two differ in terms of: first, the VAS provides the use of subsidiary ledger accounts; 2, the definition of and overall functionality of the charts of account; 3, the lack of a comprehensive income statement and the lack of fair value principle within the VAS. And finally, to conclude our meeting today, I would like to thank you everybody for carefully participating.